Hi, my name is Bob Karstens, the lead developer of ProfitGuard, the service that does the Profit Mastery math for you in the Profit Mastery format. Before ProfitGuard, I worked in the Fortune 50 business environment for over 30 years. I left the corporate world and took what I had learned to help small business like yourself. That's why I'm thrilled to be here to talk with you about my story of a company our firm represented and about their pitfalls of managing their business with a P&L alone. The agenda for this webinar is a case study about the Hello Telephone Company, not their real name to protect their privacy. The Hello Telephone Company is at a point where they'd like to expand their business and they need financing to fund the growth. We will build their projected income statement, also known as a P&L or profit and loss, projecting their sales, their cost of goods sold, and all their expenses ultimately to get to net profits. Then we will calculate how much money they need to fund this growth, and we will measure the actual performance to plan. Then finally, we will discuss their final results and go over some conclusions. The background for the Hello Telephone Company is they are an electronic engineering and manufacturing company that has invented a unique voice-over IP telephone. The product allows the user to make telephone calls using their internet connection within their home or business. They have been in business for 24 months. The first 12 months was for research and development of the product, and the second 12 months they were selling the product into the local retail market. The company now feels their quality and costs are in line to expand the business to the next step by growing their sales to regional retailers. They have been able to negotiate a distribution agreement with Tiger Direct and Fry's selling their telephone. These retailers have an online internet presence but have chosen only to sell out of their retail stores in their regions. As part of the agreement, both retailers will forecast the purchases. For manufacturing the phone, they currently are using a local manufacturer that is not cost-effective because of the costs of the product are too high and they will need $500,000 to expand the factory in order to handle the higher volume that is forecasted by Tiger Direct and Fry's. Through a local Far East manufacturer representative, they decided to transition their manufacturing to China. The pros for doing this are first the low cost of $8 less for the product landed in their local warehouse, then minimal tooling. There is no additional factory capital required as this manufacturer builds these types of products already and has plenty of capacity. And finally, the materials are all sourced in Asia. But there are some shortcomings to manufacturing in China, as they must pay in advance for all the products they want using a letter of credit, which is basically a way of putting money into an escrow account in a bank, and that money will be released to the manufacturer once the product has been delivered to the Hello Telephone Company's warehouse. With this process, they wind up with a 75-day lead time, which is the time from the order to the time the product arrives in the warehouse. Now let's build the projected income statement for the first 18 months of this plan. They actually built a full 3-year P&L, but we will just go over the ramp-up period until they reach their final volume. The assumptions for this income statement are the retailers will forecast the sales, so as you can see, the first 6 months, the line will be 1,300 units a month, which is the current run rate with their local retailers. Then the 7th through the 15th month, they will grow the business to ultimately reach 10,000 units per month, a nearly 8 times increase in volume. The next assumption is the price to the retailer will be $100. That is the wholesale price. The retail price will be $200 or a 50% retail margin or 100% markup. Then finally, the cost of goods sold, which is the product cost landed in the retailer, will be $52. All the numbers on the spreadsheet, with exception of volume, will be in thousands. The first line of the income statement will be the top line, which is sales or revenue. The way that is calculated is simply take the volume in any given month, multiply it by $100, that results in $200,000 shown in the date of 1/31/13. The cost of goods sold will be calculated in a similar manner by taking the same volume in any given month, multiply the cost of goods sold of $52, and that will result in $140,000. The difference between the sales and the costs will be gross margin. The next line of the income statement will be depreciation and amortization. In this case, it's only depreciation of the test equipment that they purchased some time ago to develop the product. Amortization is a purchase of something that you spread the costs of that expense over time rather than expensing it all at once. This is often done with major purchases. The next account is the marketing, sales, G&A, that essentially is your payroll and all other operating expenses and overhead, not including research and development, because research and development is a significant expense to this company and they want to keep track of that as an individual item. Then we have the interest expense. This is the interest of any bank loan or any loan they have outstanding. In this particular case, it's the interest on what is owed on the test equipment. The next account is income tax, which is simply the taxes they pay each month or each quarter in most cases. Then everything is subtracted from the sales line to give the bottom line of net profit. As you can see, they have negative net profit of $2,000, then $8,000 in these 2 months. So to calculate what they need to cover these losses, they simply add these two numbers together, which results in a total of $10,000 is needed to fund this particular plan. After the negative $8,000, they have positive net profit, so they should not need any more funding. I always like to look at things graphically, so let's look at part of the income statement quarterly. This first chart shows the company's sales quarterly. As you see, the first 2 quarter periods, their current sales to the local retailer, and after that there's a quick ramp that takes about a year to get up to the final volume of $3 million a quarter. Now let's superimpose the net profit for the Hello Telephone Company. This graph uses the left axis. As you can see, the net profit is nearly zero in the first 2 quarters, then ramps up to a steady state of about $800,000 a quarter. So next was to look at what happened to the company. After the first 3 months, the accountant came to the CEO and informed them they were out of money to pay expenses. The CEO had a line of credit already at the bank and took out a short-term loan to pay these expenses. The next month was a repeat of the cash problem again. They took out another short-term loan at the bank to meet these expenses. What's going on? They were meeting their plan as identified in the income statement, so was there a mistake? Let's go back and look a little deeper and know what's going on in this business. As I showed you earlier, sales and net profit. But what we did not look at is their operating cash flow. This is the cash flow for the operations. Putting that on the graph, you can see they have a negative cash flow for 5 straight quarters at a rate of negative $200,000 per quarter. So let's go back and revisit their business model. In particular, their cash flow model. You can recall, to get their new business model going with having China build their products, they first have to put money into a bank in advance to get the China company to build the product. Once it's built, they ship it to the Hello Telephone Company's warehouse in the U.S. That total cycle is 75 days. Then once they have the product in the warehouse, they ship it to the retailers. The retailer stocks the inventory, sells the goods, but does not pay until another 45 days later. So the total time the Hello Telephone Company has their cash suspended in their business is 120 days. This cycle is known as the cash conversion cycle. So this means the company invests money into the business but does not get any benefit back from that investment for a total of 120 days, or nearly a quarter year. So let's look how this looks graphically for the business in average days. So once again, we will graph each quarter over a 2.5-year period. The first line plotted is inventory. Their inventory levels were 30 days, or 1 month when they were building locally and selling to local retailers. But when they moved over to manufacturing in China, the number grew rapidly to 75 days. The next item we'll graph is receivables, or the time in which the retailer pays them. When they were local, they were around 15 days. Then when they moved to regional retailers, that is extended out to 45 days. The last item we will graph is their accounts payable. Accounts payable is how long they take to pay their suppliers of the product. When we were looking locally, they took about 5 days to pay their suppliers, but in this case of China, they have to prepay for their payments at 0 days. So if the cash conversion cycle is plotted for receivable days plus inventory days minus payable days, you can see the Hello Telephone Company went from average of 42 days up to 120 days, as we saw in their financial diagram earlier. So what is not captured in the income statement that they use to determine their financial requirements is the fact they need to fund the money being suspended in their business for 120 days. In the P&L, a sale does not mean cash back in the business. After the sale is made, it will take 120 days for them to get the cash for that sale. Now let's look at what their cash was doing over the same time period. As you can see, they had negative cash accumulated up to $1 million for 15 months. This was 21 months before they were cash positive in this business model. So the funding they really needed for this business was over $1 million, not $10,000, as originally calculated using the income statement alone. So to make the decision to move to manufacturing to China may not have been so wise. So let's look at the same business model, but in this case, they continue to build locally, but still sell to the regional retailers. When we do this, the assumptions will change in the business model. The first change is our cost of goods sold will be increased by the $8. So instead of $52 the cost of goods sold, they now have a $60 cost of goods sold. Another assumption change is they now have 30 days payable to their supplier. In other words, their local manufacturer will deliver the product and the Hello Telephone Company can take up to 30 days to pay them. Additionally, their inventory days can be managed to a much lower level. They only need 30 days of inventory to supply the regional retailers. But as stated earlier, expanding the local factory would require $500,000. So now let's plot what the cash will look like for these changes to the Hello Telephone Company. They will only need $412,000 to fund this business with local manufacturing. That is $600,000 less than what they needed when they built the telephones in China. So the cash conversion cycle is down to 45 days versus the 120 days in China. So let's look at what actually happened. We were commissioned to help them out of their difficult situation. We first helped them acquire a $500,000 loan. Then we terminated manufacturing in China except for what was already committed in their current manufacturing cycle. At the same time, they invested in capitalization of the local manufacturer and transitioned to the local manufacturer building the product. Unfortunately, the recovery time took 12 months, but at least they were on a path to get healthy again. So in conclusion, funding cannot be determined from a P&L alone. The cash conversion cycle is very critical to determine your cash flow. What that includes is receivables, which is how fast your company will pay to collect from their customers, inventory levels representing the amount of stock of product you have to supply your customers, and payables, how fast you pay your suppliers for what they supply you. Manufacturing and distribution decisions impact your cash flow. So when you're building a plan to expand, first you have to consider manufacturing. You can choose outsourcing or building it yourself. You also choose whether to build far distances from your warehouse, such as the Far East, or local manufacturing. There are distribution considerations. You can choose to sell directly to retailers or sell to distributors, or you could consider distributors versus direct sales through the internet. But when you're done with your plan, you need to test multiple strategies to see which one makes the most sense for your business. There are multiple ways to get to success or failure. We are told by the Small Business Administration 55% of small businesses fail in the first 5 years. The main reason for this is running out of cash. We certainly don't want this to happen to your business. We have some resources for you that you can use to better understand the principles that we discovered for the Hello Telephone Company. The first is Profit Mastery, financial training for CEOs and business owners. The second part is Profit Guard. Profit Guard does the Profit Mastery math automatically. And then for those that took the time to join our webinar, we have a special offer, a free trial report. Simply enter this free trial code in the coupon box, then sign up for Profit Guard. Profit Guard provides you a monthly assessment of your business using a scorecard, the profit roadmap, the Profit Mastery assessment, the break-even analysis, and the financial gap. Thank you all for joining us.